October's inflation slowdown has sparked market optimism. Our next guest says that the data could mark the end of the Fed's rate tightening cycle. I want to bring in chief economics correspondent at the Wall Street Journal, Nick Timiraos. Nick, is this mission accomplished for the Fed?
You know, it could be. It sure looks like it might be, but they're not going to say it. I think, Becky, they're going to be the last ones to say it. So is the Fed done? Yes, it looks likely, but they are going to be the last ones to say it. I think the question here is, where is the case to raise rates right now from here? I mean, you would need to see something in the data that, frankly, we're just not seeing. You would need to see some kind of adverse supply shock. So they have to be relieved, if not quite pleased with where the data is coming in here. I mean, if you go back 6 months, let's go back to May and look at where we were in May. We were getting core inflation readings using the PCE. The first 5 months of the year annualized at 4.4%. The 5 months since then, if you kind of take the CPI and look at what it's going to do in October for the PCE, you're looking at 2.4% on a 5-month annualized basis. So we had a banking crisis. They hiked through a banking crisis. Right now, this looks like a Fed that does not want to hike again. They will if they're dragged into it, but the data is not going to drag them into it if it continues like this.
You know, Nick, I was trying to get my arms around how much has changed in such a short period of time, just in the last 5 weeks. I went back and read an article you wrote at the beginning of October, just talking about how the serious and sudden jump in long-term rates was really threatening any sort of a soft landing. And at that point, we were trying to figure out what caused it. It wasn't the Fed. We kind of thought that rates were getting away from the Fed. Maybe it was the bond vigilantes. Maybe it was some concern about high deficits and debt levels in Washington. Can we say that that is not a concern at this point, or is this temporary respite? I mean, is this respite that we're seeing in rates, is that a temporary thing?
Yeah, I think it's too soon to tell. I mean, we get a data point every week, it seems, and people sort of change their view on what the economy's doing. So we got that October payroll number at the beginning of this month, and people started talking about, oh, gee, recession. When is the Fed going to cut rates? Could it be in the second quarter next year? And then last week we saw the University of Michigan inflation expectations number tick back up, and people said, oh, no, is the Fed going to have to hike again? And then we got the cool inflation readings these last 2 days. So, there's a lot of uncertainty right now, obviously. If you look at Treasury yields, I mean, they're still higher than they were at the last meeting where the Fed hiked, which was in July. They're higher than at the September meeting, which was when the Fed came out with what some people thought was a more hawkish set of projections in the dot plot.
That's right.
That was a set of projections that basically said you're not going to get cuts for nothing, right? If you take the recession or the slowdown out of the forecast next year, then you're taking the cuts away too. So that's one thing I think a lot of people will be looking at the December forecast round.
Some people at the time claimed that the way Jay Powell said higher for longer was he said it this way instead of
higher for longer.
Yeah, he said and that it actually was Jay Powell that caused those long rates to go up. Thankfully, you know what you haven't said anything about, Nick? Like a 150 basis point rise in unemployment, or unemployment. Yeah, we used to think that that's what the Fed was disappointed it hadn't orchestrated, which that's horrible. That's a horrible way to view to manage an economy. That you need to add to the unemployment ranks to accomplish your goals, and that hasn't happened. And maybe it was always about inflation. Maybe we didn't have to actually induce some pain for the Fed to get to where it wanted to be.
Well, and I think you still have, Joe, this question about the lags, right? Are we past, you talk about peak, are we past peak tightening and peak lags, or are the impacts of a 5 3/8 funds rate still to be felt? I mean, we went through years of very low interest rates, and so now you kind of have this period where, all right, maybe households and corporates have been more resilient because they termed out their debt in 2020 and 2021, but will it catch up at some point? I think that's, still a question to be answered. And then I think you do have this question next year about what is the Fed's reaction function around rate cuts if we do not have the increase in unemployment, if we do not have a serious growth scare, that would be a first-class problem, frankly, for the Fed to have to discuss is, gee, what is our reaction function to bringing interest rates down?
Your colleagues at the Journal already said economy closes in on a soft landing. Inflation eases with no signs of a recession. So maybe we don't need the lags to eventually cause higher unemployment. Maybe we've already orchestrated, the Fed has already orchestrated that soft landing. But I don't know. We don't know. You're right.
These things take time. Maybe we're in the third quarter, maybe we're in the fourth quarter. There's still some game to play.
Weird article that almost a mission accomplished banner type article. Lead story.